Understanding liquidity premium, an in-depth guide. Liquidity premium is a critical concept in finance, grounded in the notion that investors require additional compensation for bearing the risks associated with holding assets that are not easily or quickly convertible into cash at fair market value. This article delves into the intricacies of liquidity premium, its implications for investment strategies, and the importance of understanding liquidity in risk management. What is liquidity premium? Liquidity premium represents the extra yield on an investment attributed to its illiquidity. Investments that are difficult to sell or convert into cash without significant value depreciation typically carry a higher interest rate compared to more liquid investments. For instance, long-term bonds generally offer a higher yield than short-term bonds as they are less liquid, thus providing a liquidity premium to the investor who takes on additional risk. Key takeaways. Liquidity premium, the additional yield that compensates investors for holding less liquid assets. Investment risk, illiquidity complicates the quick sale of an asset, possibly resulting in a loss if the asset must be sold urgently. Illiquidity factor, the less liquid the investment, the greater the liquidity premium required by investors. The nature of illiquidity. Investing in illiquid assets comes with a spectrum of risks. Illiquidity can translate to opportunity costs if more lucrative investments arise while capital is tied up in an illiquid asset. It becomes imperative for investors to balance their portfolios in a manner that aligns with their liquidity preferences and risk tolerance. Illiquid assets examples. Some common examples of illiquid investments include art and collectibles. Items like antiques, rare stamps, or artwork can be challenging to sell quickly due to fluctuating markets and specialized demand. Commodities, physical goods like metals and agricultural products may require substantial time and effort to convert into cash. Private equity investments, shares in private companies are typically less liquid due to the absence of a public trading market. Real estate, properties can take time to sell at market value, presenting liquidity challenges for investors. Less traded bonds, municipal and corporate bonds with low trading volumes present additional illiquidity risks. Understanding these risks is crucial for any investor who wants to incorporate illiquid assets into their portfolio. The relationship between liquidity premium and yield curve. The yield curve illustrates the relationship between interest rates and bond maturities. In a typical scenario, longer maturities yield higher returns, primarily due to the liquidity premium. Investors naturally demand higher yields for locking their funds in longer-term investments that are less liquid. Liquidity premium calculation. To determine a liquidity premium, investors can compare yields between two similar investments, one liquid and one illiquid. For example, if a publicly traded bond offers a yield of 3% and a non-traded bond with the same credit risk offers 5%, the liquidity premium would be 2%. This relative difference is pivotal for assessing the return on investing in illiquid assets. The pros and cons of high liquidity premiums. While a high liquidity premium indicates a potential for greater long-term returns, the trade-off comes with increased risk and the forfeiture of flexibility. Thus, the key for investors is to determine whether the higher returns justify the illiquidity risk. Negative liquidity premiums. Although uncommon, negative liquidity premiums can occur, especially during inverted yield curves, where longer-term securities provide yields lower than their short-term counterparts. Such phenomena are often seen as signals of economic distress and can influence broader market behavior. Liquidity trap scenario. A liquidity trap is a situation where money is hoarded by individuals due to expectations of stagnant prices or declining values. This behavior can lead to ineffective monetary policies by central banks trying to stimulate economic activity, often resulting in prolonged periods of low growth and inflationary pressures. Conclusion. The concept of liquidity premium plays a pivotal role in investment decision-making and risk management. By understanding the relationship between liquidity and yield, investors can better navigate the complexities of their portfolios. Effective assessment of liquidity premium allows individuals and institutions to balance the potential risks and returns inherent in various investment options, leading to more informed investment strategies. Ultimately, this comprehension aids in aligning investment choices with financial goals and liquidity necessities.